Hello, and welcome to Better Investing. Today we are going to look at what PEG ratio is, what do it mean, how do we calculate it, and what can we use it for? PEG stands for price earnings to growth. The PEG ratio is a stock's price to earnings ratio divided by the growth rate of its earnings for a specified time period. The PEG ratio is used to determine a stock's value while also factoring in the company's expected earnings growth, and it is thought to provide a more complete picture than the more standard PE ratio. The PEG ratio is calculated by dividing the PE ratio to the growth rate of its earnings for a specified time period. The PE ratio is the price to earnings. If you don't know what it is or how to calculate it, make sure to check my video on it. Once you have found the PE ratio, you need to find the EPS growth. To find the EPS, you can simply divide the company's profit to the numbers of shares outstanding. So to find the EPS growth, you need to look at the EPS for previous years to compare. The ratio can be calculated using 1-year, 3-year, or 5-year expected growth rates. For example, let's take an example to calculate the PEG ratio for a random company. Assume that a company has $2 in EPS this year and had a $1.50 EPS last year. Then the EPS growth would be calculated by taking $2 divided by $1.50 minus 1. That equals a 33% EPS growth for the past year. Now we need to calculate the PE. Let's assume the stock price is $40, then we'll just divide that by the $2 EPS, that equals $20. Then the PEG ratio will be calculated by taking 20 divided by 33, that equals 0.6. That means that the PEG ratio is 0.6. What counts as a good PEG ratio will depend on the industry in question and the overall state of valuations in the market. The lower the PEG ratio, the more the stock may be undervalued given its future earnings expectations. Adding a company's expected growth into the ratio helps to adjust the result for companies that may have a high growth rate and a high PE ratio. The degree to which a PEG ratio result indicates an over or underpriced stock varies by industry and by company type. As a broad rule of thumb, some investors feel that a PEG ratio below 1 is desirable. According to well-known investor Peter Lynch, a company's PE and expected growth should be equal, which denotes a fairly valued company and supports a PEG ratio of 1.0. When a company's PEG exceeds 1.0, it's considered overvalued, while a stock with a PEG of less than 1.0 is considered undervalued. The PEG for a given company may differ significantly from one reported source to another, depending on which growth estimate is used in the calculation, such as 1-year or 3-year projected growth. Thanks for watching. Please like and subscribe for more content.